Hi there, and you're watching the weekly wrap-up with me, Darren McDermott. I have Guy Foster from Brewin Dolphin in London on the line. So Guy, what did you think about jobless claims and all the other US data we saw this week, including retail sales?
We had an interesting set of payroll numbers yesterday from the US. Interesting because they caused a bit of a stir in the market with initial claims, which is the most closely followed number released in that package, falling very sharply, suspiciously sharply. And in fact, it turned out that two states, we don't know which ones, didn't have their figures included within that package. So essentially, the main number that is interesting from the jobless claims, the initial jobless claims, doesn't really tell us anything this week. But the continuing claims, which is for a slightly different period, were also better than expected. So there's nothing really about this package that would upset the market's general view and our general view that the employment position is improving in a gradual way. As far as retail sales are concerned, I mean, this is actually, again, this is a number which gets revised quite a few times after this initial advance release. So these numbers for August are expected to show, again, some modest growth, but we probably won't really know how meaningful that is for another two months or so. They would be interesting numbers to follow, and the other kind of proxies that you can get for retail sales are very interesting, because what we are seeing is a decline in some measures of US economic activity, but not others. And so most notably, new house building and new house sales really seem to have stalled, and that's despite being at very low levels and despite having historically huge amounts of pent-up demand. And the principal explanation for that is that higher bond yields are impairing mortgage affordability and access to the mortgage market. But there's probably some element as well of fatigue from US households, just bearing in mind that they've already suffered a 2% payroll tax hike at the beginning of 2013, and then several tranches of federal spending cuts as a result of the sequestration program. So these higher mortgage rates as well are removing some of the potential reduction in household costs from lower mortgage finance rates. So there's scope for things like retail sales to start reflecting that fatigue over the coming months.
And Guy, what do you think were the main driving factors of Asian markets this week?
So Asian markets have seen some improvement, and they've seen some stability, and I think some of the factors related to that are that, essentially there had already been very sharp reductions in currencies, so as a general trend towards slightly more competitiveness. Specifically, this is from the troubled current account deficit countries, so the Indonesias, Indias, and places like that. But they've also, I think, responded quite well to what is a generally somewhat better trend of news flow from China. And I think the thing with China we've got to understand is that it has seen its measures of economic activity generally trending lower over the last 18 months or so, and there's a few schools of thought really about whether this is a sort of soft landing, hard landing, or complete and total collapse. And I think what investors have just seen over the last couple of weeks really from Chinese data is that it is slowing down, and that's something which is pretty much unavoidable given the position, given the excesses in shadow banking in the housing market, which China's trying to unwind, and given its attempts to reorientate its economy more towards consumption and less towards export-driven growth. Because of that shift, there's going to be modest reductions in growth, but it doesn't necessarily mean that you're going to have a complete and total collapse. And I think that's what investors have been treating with a bit more optimism. There's also, as an aside, you've also had the Syrian situation, and a lot of these Asian economies are big users of oil and very sensitive to the oil price. So the slight mellowing in geopolitical tensions been quite helpful to them as well.
And in the September ECB monthly report, the Governing Council pointed to the progressing recovery in the Eurozone, with a second consecutive quarter of positive growth and a significant improvement in confidence indicators seen in the recent months. Now, the ECB have revised their growth forecasts. So what do you think about this and about the statement?
It's certainly encouraging to see better sentiment indicators from Europe. But what we have particularly seen over the last or the last month or so is two indicators which should be quite closely aligned, which are money supply and sentiment, have now diverged. So money supply has started to soften. Now, I think that's quite important because both of those tend to lead industrial production, and if they're going to diverge, then it implies a more uncertain future for industrial production, which was looking quite rosy. In fact, yesterday we had the Italian industrial production numbers, which were really quite surprisingly poor. And so it does just raise questions about whether there might be a touch of complacency about the new sense of optimism for the Eurozone. After all, I mean, we have seen a very, very sharp reduction, or a very sharp and prolonged reduction in GDP growth, and I think it's natural that it would stabilise at some stage. That doesn't necessarily mean that it's about to recover in a cyclical fashion, when particularly there are no driving stimulus policies really that are being exacted upon the Eurozone economy right at the moment. And the big policy push at the moment being practiced all over the world is this one of using forward guidance, and certainly that's been used to the least effect in the Eurozone, where there's no real guidance on how long rates are going to stay low for, other than that it will be for a prolonged period of time. And you can see, if you look at market interest rates, that the market has treated that as a pretty much a meaningless statement. So policy, I think, in the Eurozone could do with being a bit looser, and we might have to see the ECB taking more concrete action over the following months.
Great. Thank you, Guy, for that. Well, viewers, we will be back on Monday, so see you then.